funny to hear about just all the different ways that people are, I guess, getting in and or out of real estate, depending on your investment strategies. But with real estate going up right now around here, and I mean, doesn't seem to be a very big end in sight. What's your take on the general real estate market? And I guess how people can invest, or how do they become landlords, or do you see more of that?
Well, I mean, we're definitely seeing more of it. People are getting more comfortable with the fact that it's, real estate is a good, sound investment. We all kind of got slapped upside the head and said, okay, we can't put our blinders on and just throw money at this and think we're going to make money back forever. It's not this, optimal pyramid scheme. But if you do it intelligently, with rates at what they are, you can get in there, get a house, make the mortgage, that kind of thing. Locally in, your Seattle and East Side markets, you're not going to make a killing on rental properties because the mortgages or the amount you pay for the house is high relative to the rent you make. But with the low interest rates, that makes it better. So, I mean, it's a balance. It's a good way to balance a portfolio. I don't necessarily recommend to people that they do what I do, which is pretty much make it almost the entire portfolio. But
sure. Well, you're involved in real estate on a daily basis. I think what's scary is when people come out from Microsoft and like, I'm a landlord.
Yeah.
I'm going to become that's my next job.
Yep.
And they can put themselves into a place where they can get in a lot of trouble.
Right. Oh, without a doubt. Yeah. And I just had a situation recently where, I had a tech client that had a rental, and I'd call her a reluctant landlord because she was in a position where she was relocating to California. She had this rental house that she would have loved to have sold, but the market was down, so she couldn't sell it. Well, now the market's up and she can sell it, but the tenant's coming back and I had put pets in the house and had ruined the blinds and broken appliances and done all kinds of damage. None of it that's going to add up to a whole heck of a lot, but it certainly is frustrating.
Now you actually have the 3 R's of the types of landlords. And you mentioned reluctant first.
Yeah.
But so talk about what the 3 R's are, and then maybe how do you define each one?
Well, you got, my assistant actually kind of came up with this, and I don't know if she saw it online or she just pulled it out of her head, but I thought it was pretty good. And that's the reluctant, realistic, and radiant landlords. And the reluctant ones are like the gal I was just, referring to, that are kind of forced into being a landlord because of, where they are on debt to income on the house and that type of thing, or debt to value. The realistic,
no interest in actually being a landlord. They just have to be. They've become one.
Yeah. They just call me up and say, Cory, will you manage this entire thing? And it's like, oh, geez, holy cow. And I've got people that will manage the properties. So, if you don't want to be hands-on, there are always choices for doing it without, getting your hands dirty, kind of a deal. The other is the realistic, which is where they look at it and they say, hey, this is a good investment. This is a great way to diversify our portfolio. It's a phenomenal hedge against inflation. It really is. You get, lots of tax deductions. It's changed over the years, but there's still lots of benefit from that standpoint. Perfect for like planning for kids for college. You can put a rental on a 15-year arm. If you've got a really young kid, then all of a sudden 15 years from now, the rental is paid off. All that rental income just gets filtered and goes right on through to paying for college. So, lots of options like that. I've got people buying in like university areas to put their kids in the housing and then having, rent rooms, that type of thing. And then you've got the radiant landlord, which is where they're looking and they're saying, look, if I can buy a house for 10% down and I can leverage that and I'm seeing the market appreciate, all of a sudden that $10,000, the house may only go up in $50,000 in value. Well, if it's up $50,000 in value and you only had $50,000 down, that's 100% return on your money. So if you start picking up,
that's the way people thought a few years back, and that's I remember that time.
Oh yeah.
So I can put nothing down.
Yeah.
And buy 40 houses.
Right. Well, I mean, when I started out, I didn't have a very good engineer. Well, this is going way back, but my starting engineering salary was $30,000, and I think I was up to about $37,000, and I had 4 rental houses and the house I was living in, and these were all in the city of Seattle, so they weren't exactly cheap. Yeah, and I had a lot of debt relative to what my income was. So people were just letting you do that kind of stuff. And back then, it was actually legal to do different types of mortgages. The mortgage market, as you know, has gotten much more restrictive as to how you can fund things. But it's still, leveraged appreciation is still a good way to get ahead as long as you are confident that the market's going up. And right now, I think realistically, people are confident.
Talk a little bit about the cycle, the real estate cycle, and maybe where you see us in it, because leverage kind of makes sense in this upswing, right? 10% down. But what people don't remember is you could put 10% down in a downswing, and now you've lost it all. If house prices go down 10%, now you've lost that entire $50,000, right? You haven't lost 10%. And that's, I think, where you have to be pretty confident to go in with leverage in that the housing market will continue to go up, because if it drops that 10%, you've lost 100% of your investment.
Yep, and that's true, but you've only lost that 100% if you have to sell. So if you have a renter in there that is paying you rental income and you have a strong rental market, I mean, I had, 12 properties or something when the market tanked? Not fun times, but now that it's coming back, through those times, a lot of those were vacant lots, but through those times, the rental income didn't change.
You're renting them to campers?
Yeah, exactly. I should have been.
Yeah.
But the rental income doesn't change. I mean, it changes a little bit. It went down a little bit. Then it actually shot up quite a bit. So you see some ebb and flow to it. But generally, people have to have a place to live. And if they have a bankruptcy, a short sale, or something on their title or credit report, a lot of those people still have good jobs. They're getting paid good money. They're still looking for rental houses. So if you buy a rental house in the right locations, for instance, let's say by the UW, there's always going to be people that need to go to college there. I mean, they've got like 40,000 people there now. There's always a basis for a rental income there. So, your risk in real estate is, some of that is minimized with time. Different than some other investments because you can still get some income generated.
It's kind of a two-way street. You're not just buying something that doesn't have any chance of getting you some money back.
Right.
I mean, everything will rent at a price.
Right. Yeah. Well, and the other interesting thing, so I used to live in New Zealand, and we're heading back down there to visit here in less than a month, but they didn't get any tax deduction write-offs for rental properties. They didn't have any interest deductions. The appreciation when we lived down there was next to nothing, almost zero, and there were still people with rental properties. And that was because, you had that renter in there. It made sense. They're paying your mortgage. Eventually, it's a good play. And you just have to analyze the numbers. It doesn't mean that, hey, run out there and buy a bunch of houses, because you want to look at your stock options. You want to look at your real estate options. You have choices. Any choice you make, there's an opportunity cost to it.
At the very beginning of the show, I discussed a little about that motivation versus content. And right now, it's very easy to get motivated into jumping into real estate because, of course, now national media is talking about it. President's talking about it. Everything is fine and dandy in the real estate industry again. And then, of course, people are starting to feel like, oh, now it's time to get in. And that can be a real scary proposition because, of course, the time to get in was 2 years ago. Now's the time to maybe, dip. You're not. I guess what I'm trying to say is, it's not the no-brainer to just go out and buy as many properties as you can because it's honky-dory on the TV every night.
Yeah, I am not a big believer in watching the TV other than to watch the herding mentality. Because when the herd starts turning, then you're in trouble.
Right. That's kind of what I'm saying is the herd, in some ways, is starting to turn. Real estate is getting very popular again.
Oh, yeah, it's turning, and everybody's charging up the hill thinking this is awesome, this is awesome, this is awesome. I think we're going to still be charging up that hill next year and probably a little bit the year after that. I do think we'll flatten out. Interest rates are going to go up. If we keep on this cycle of 10 to 15% appreciation, at some point, we're going to see 10 to 15% depreciation.
Right. Well, what? And the other thing I brought up a few weeks ago was if you just look at the median income and maybe go a little bit above it and the median house price, at some point in time, lenders are not going to finance above these numbers. I mean, there's almost a cap because most people are still financing houses. So you could look at what the maxed financeable, the most people are going to be able to finance from.
Yeah, and I mean, what is the statistic now? Isn't it like 30% of the houses in America are owned with cash, owned free and clear?
I don't know the answer to that, but
Yeah, I think it's a much higher percentage than you would think. Much, much higher. So, but last time I checked, it was close to 40% of house buyers were first-time buyers too. So, most of those guys aren't coming in with cash.
Sure.
I mean, now granted, if they had lived in their mom's basement for a decade, then maybe they do have the cash. But
I'm pretty sure mom or Dennis will be kicking them out.
Yeah. So, and the interesting thing is, and I know people that are living at home. I mean, the Seattle's biggest fan, the Seahawks guy, and I don't know if he still does, but he won the lottery. From what my understanding of his story is, he won the lottery, won $1 million, and was still living at home in his mom's basement. It's a choice. It's not always a financial play. It's a choice of having that freedom to be able to do whatever they want.
Sure.
And as, they get older and they start families or whatever, then yeah, they're going to say, okay, now I need a house. I mean, even if the Seattle bubble guy bought a house, then you got to figure.
He did like a year and a half ago, too.
Yeah.
He did.